Welcome to the Daily Update, where I'll go over the action in the market for Friday, June 2nd, and then we'll see how things look for Monday, June 5th. We had another really solid up day. The interesting thing about Friday is we saw more broad participation by stocks that really hadn't been going up or really moving all that much lately. Some of the areas that have been outperforming, they underperformed on Friday, but some of the underperforming areas actually did a lot better. It's really helped to improve our overall technical picture. Some of those negatives that we're seeing and negative divergences, they're still there, but a lot of them are really showing some improvement. So before I get started, I do have a PDF that you can download with all of the slides and charts. If you're having trouble seeing the charts in the video, please download that PDF and see if that helps you. If not, contact me. We'll try to come up with something else. I do have a private Facebook group that you're welcome to join. I do have a poll that's posted. I'll be taking that down over the weekend and then putting up a new poll for the upcoming week. I do also post on Rumble, so if you can't find me on YouTube, please go over to this channel and you should be able to find a video there. All right, let's talk about what happened. At the open, we had a gap higher open. We were above R1 right out of the gate at 42.45, and then we quickly rose up to R2 at 42.69. As the day went on, we just drifted sideways after that. We didn't really make a run for R3. That was quite a bit above current price. But we were able to hold on to those gains. We didn't see a lot of selling into strength, and then we ended up closing above R2. So we were up 1.45% on above average volume. That's encouraging. Our technicals are switching back more positive. We are looking a little overextended in the short term, and that's to be expected, especially when we're coming out of a trendless environment. The debt ceiling issue has pretty much been dealt with now, and we might have seen some positive reaction to that in Friday's session. So now it's all switching back to inflation and interest rates. Value outperformed growth on Friday, but there was broader participation in the rally, so that's rather encouraging. There was a positive reaction to the debt ceiling deal as well as the employment situation report. Small caps, which had been really underperforming as a whole, they were up 3.6%. And then recent strong areas did underperform, including communication as well as tech. On a short-term basis, we have the Stoke RSI and the Williams Percent R, as well as the CCI 14 and 20 and the short-term stochastics. Those are all extreme positive. On one hand, you can say we're looking a little exhausted here. On the other hand, you can look at this and go, wow, this just shows that there's really strong momentum. On an intermediate term basis, we have standard deviations, and I'll show you that chart. We've gone up a little too far too fast. The percent B index also suggests that we've gone up too far too fast, and the Sean trend meter is still looking more extreme positive. The dollar was up and interest rates were also up, and we still have the yield curves that we're watching that remain inverted. Sentiment is positive. It ticked down a little bit to 65 where it had been at 67. And our trend is positive. It's getting stronger. The green line's on top and it's going up. But when you look at the ADX and its moving average, they're still below 20. Our bias is positive, and I'm still keeping our momentum mixed to positive. It's probably more with a positive slant. The economic reports that came out. This was the big report of the month. Non-farm payrolls came in at 339,000, a lot more than the 190,000 than they had expected, and much greater than the 294,000 that we saw last time. Non-farm private payrolls also greater than the 177 expected. They came in at 283,000. Last time they came in at 253,000. The average hourly earnings stayed the same at 0.3%. Last time they had been up 0.4%. The unemployment rate ticked up to 3.7%, where it was at 3.4%. They expected it to come in at 3.5%. The average hour work week was 34.3 hours, a little bit less than the 34.4 they had expected, and that's what we saw last time as well. Looking at some Isabel Net blog charts, where this is the ISM manufacturing, one of the big employment reports that we get. The purple line is the S&P 500. The gold line is the ISM manufacturing, where it still continues to go down. There is a strong tendency for the S&P and this report to go in the same general direction. They're getting a little far apart from each other. The hope is economically that maybe this gold line will turn and go back up, or is that going to put some pressure on the S&P to come back down? Then we look at other statistics for the month of June, and you can take all this data and come up with all different kinds of answers. But this chart just says June can be a weak month, where sometimes it's down overall over the past 20 years, where other times it ends up being positive. They also show the pre-election years, and that's when it tends to do the best, and that's where we're at right now. Then we're looking at massive inflows into tech. People are chasing the returns, and when they see that the tech sector is looking stronger again, they just start throwing money into that. This could be a little extreme. Then we're looking at the weekly equity fund flows, showing that overall there was a lot of money going into stocks. And when we look at the 12-week average, it's also showing some improvement, but it's still below zero. And then housing. We're looking at the purchase index, where it had been showing some improvement, and now it's been starting to come back down. That's what we're seeing seasonally as well when you compare it to other years. After this, we should see a little bit of a turn up if we stick to historical norms. The economic reports that came out, here's the unemployment rate showing that it's still really low overall, but it did tick up to 3.7%. And then this is what we look at for the comparison, where the red line is the initial claims, and they are starting to increase. The continuing claims are actually coming down just a little bit, and it's hard to see here, but the unemployment rate did tick up slightly. Keeping an eye on the Fed, because we're coming up to that June 14th meeting, there's still a 74.7% chance that the Fed will leave rates unchanged. And here's how it's changed over the last few days. The dark blue is where we're at right now. One day ago, it actually dropped down from the percentage that think we will leave them unchanged. But this was a really big increase over what we saw a week ago, but a little bit of a decrease from what we saw a month ago. All right, let's get into our charts here. Here's the intraday chart showing how we gapped up above R1. We quickly made it up to R2. There was a little bit of selling right out of the gate. We never came down to actually fill this gap, and that's where I was really watching things to wonder, are we going to keep falling? Could we come down to the unchanged level? No, we didn't get down that far before turning around and going back up. We got above R2. R3 was way up here, and we weren't really close to it. And we pretty much held on to the gains going into the close. Here's the 10-minute intraday chart where I do have the pre-market data this time. The initial overnight session was pretty much flat. We saw things pick up and go positive in the pre-market session. And then here is what happened during the day, and we drifted sideways as the futures closed for the week. We did see a few times on Friday where value outperformed growth. So this red line is coming back up to the green line. They both did pretty well. To see value going up, that is helping the broader scheme of the market. And here's the growth to value ratio where it underperformed as value was outperforming. We saw a little bit of a tick up going into the close. Here's where we finished on the day where growth underperformed value on the large caps, as well as the mid caps and even the small caps. But all of these were up pretty strong. Looking at sentiment, we're just dropping off as far as fear. The Ulcer Index continues to go sideways, where the VIX is just really dropping now based on the line chart as well as the bar chart. The VIX of the VIX is also continuing to drop, even though it ticked up slightly on a closing basis. And we're keeping an eye on this. It's coming back down. This spike, we only watch this when it gets above this dashed line, but we want to know about this beforehand. And we're trying to see, is some kind of an extreme reading coming? With Friday's action, it's bringing this ratio back down. Then we also look at the equity put call ratio, and I do apologize. In yesterday's video, I made an erroneous assumption where the equity put call ratio was up on an up day. It's just that my charts hadn't been updated yet, so I'm sorry about that. We're continuing to fall overall with the longer term equity put call ratio and the 5-period moving average, and that's to be expected. When the stock market is going up, this ratio tends to go down. Then looking at the skew index, where we really came up into this big move area up here, we're coming back down, but we're still in this red area. That just suggests that the market may be expecting something big to happen. And if you look at other times when we spiked and came back down, sometimes that gave support for stocks to go higher. Other times that also marked a top. So we're not quite sure what signal that's giving us. Then we look at the recent reading from the American Association of Individual Investors. They're showing some improvement overall after being pretty extreme negative. And the MOVE index ticked down, even though bonds were down as well. And the VIX also really continued to fall. So the green line, which is our spread between the two, that's going up. And here is also the S&P. The relationship remains really strong between these two. Looking at this fear gauge, it's also declining. And this other fear gauge, it's a little hard to see, but it is declining. We're still maintaining more of a risk-on posture now, where this ratio continues to go up. Our advanced decline line studies, we saw a really nice upward move based on price, and that's showing a bit of improvement with our advanced decline line on price. Volume, we are showing some improvement where we were able to cross back above the moving average. But we didn't see a real breakout in new highs. We're still going down with our 5 period and our 10 period. You can see up here in the top where we did have some new highs, but it didn't really shoot up. So that's a little bit of a concern. Accumulation distribution still remains positive, and we finally crossed back above zero with the short-term 19-period exponential moving average of the advanced decline ratio. And we're showing some improvement here with the cumulative advanced decline line. This really spiked back up. We're coming back up to this trend line when we look at the regular advanced decline line. Then this other advanced decline line, we're coming back above this upward sloping trend line. That's showing some improvement. We're still seeing a longer term divergence with common stock based on price and volume. And then our broader range, we're looking at the NYSE coming back up to the moving average. The S&P was able to get above its moving average, the mid caps up to the moving average, as well as small caps. So we're seeing some improvement here. There's room to go, and there's still a lot of improvement that needs to take place. We're short-term overbought right now, but we are showing a real sign of improvement. Looking at our trend, the ADX is still not trending. It's looking stronger with the ADX above its moving average, the green line's on top and advancing. However, if you look at the short-term ADX that I've started to show here, we have crossed above 20. So in the shorter term, we are showing a positive trend, but we're also looking a little extreme positive, depending on how you want to interpret that. Volume was above average, but it's starting to come back down after we had that huge volume day the other day. Our short-term charts, we're breaking out now with the S&P 500. We do have previous resistance here at this high set back in August. Is that going to provide some overhead resistance? And I'll end up drawing a line on this chart. You can see at the bottom where volume was above average. The Stochk RSI is extreme, as is the Williams percent R, the CCI 14, and the CCI 20. Looking at our moving average study, I haven't shown this in a while because it really hasn't been telling us anything. We're showing a lot of improvement with the 20, 50, and 200-day exponential moving averages. The short-term stochastics, not surprising, they're extreme positive. The intermediate term starting to go extreme positive, as well as the longer-term stochastics after showing us some real improvement. The force index is not extreme, but is turning back more positive. Intermediate term chart, the balance of power finally crossed above this dashed line. That's more positive. The go-no-go system remains positive with the darker blue bars. The TTM squeeze is also showing improvement. This is where we're looking a little extreme. Our standard deviations chart is now into the third standard deviation, meaning that we've gone up pretty far, pretty fast. And the Bollinger Bands, we're starting to go outside of the upper Bollinger Band, and we're also seeing that with the percent B indicator, where we're extreme with that. The PPO, still looking positive in all time frames. And the Arun is also showing some improvement and is positive. The McClellan oscillator was able to cross back above zero. That's more positive. The NYSE McClellan oscillator also showing a lot of improvement. And the summation index based on price is turning back up, and we're starting to cross back above zero based on volume. Our NYSE summation index turned up just slightly, both based on price and volume, so not a lot of improvement there. The Swenlin trading oscillator crossed above zero based on price and volume, showing some improvement. The PMOs turning back up based on price. We're not quite crossed above the moving average, where we're starting to look more positive based on volume. Our PMO study, we're really coming up with the PMOs that are rising, almost to an extreme reading, turning back up with the buy signals and starting to turn back up with the PMOs that are above zero. The parabolic SAR remains positive. The Elder Impulse system for the S&P remains positive. The slope indicator is still positive. The MACD continues to be turning back up. That's positive. All of our oscillators are turning more positive. Longer term, we're still pretty much flat. And we're still above all the plotted moving averages in our moving average tree. The Sean trend meter starting to get extreme positive. And the BPI showing some improvement, but it's still below 50, even though it ticked up on Friday. The NYSE BPI is also showing some improvement, but is still below 0. The Chaikin money flow showing a lot of improvement. The Chaikin oscillator also improving. The money flow is also positive. The vortex is turning back up. That's positive. The ultimate oscillator is also positive. The RSI in 14 periods above 50 and advancing, starting to look a little extreme with the 9 period, but we're not quite there yet. On balance volume above the moving average and advancing, that's positive. We're seeing some improvement with our negative divergence when we look at the 20 and 50 period moving average study. They're still negatively diverging, but this did tick up on Friday and it is looking better. The Copic curve continues to be on a buy signal, as does the Pring bottom fisher. Looking at our Fibonacci lines, we're still above this 4170 level. If we start to fall, we'll see if that provides support. We're above the 100% retracement now, and we're starting to battle back to this high that we set in August. If we continue to go up, that will probably act as some kind of resistance. Longer term, we're still battling with this 61.8% retracement level. We're below that. If we start to fall, we're looking at the 4156 level. And then longer term, we broke out above 4214, so that's positive, but we're going to keep an eye on this previous high. We're also breaking out above this downward sloping trend line. This looked like it was really going to provide some resistance, and it did for a few days, but then we've been able to break back above that. Can we keep going from here? Our different charts are looking more positive. The Heikin Ashi is good, the Renko is good, the Kegi is good, and the 3-line break is good. Our different indexes, even though the equal weight is still underperforming the S&P, it showed some real improvement on Friday. We're still seeing longer-term negative divergence between the Dow and the transports. We saw a little bit of improvement with the utilities. And our new take on Dow theory, we're breaking out with the S&P and also breaking out with the NASDAQ. The transports continue to underperform the Dow. That's longer-term negative. And we saw a little bit of a tick down in the ratio where the big stocks didn't outperform the small stocks as much on Friday. Looking at the Dow, we were able to get back above its 50-period moving average, but we do have some overhead resistance above current price, and the diamonds have switched back to positive. The NASDAQ also breaking out and could have some overhead resistance at R1. We're still seeing a negative divergence here with the cumulative new highs minus the new lows, but on the positive side, we broke above 0 when we subtract the new lows from the new highs. The NASDAQ is coming back up to this 50% retracement level and was able to close above that. That's positive not only on a daily chart, but also on the weekly chart. The NASDAQ 100 also breaking out and looking positive. The Qs remain positive. And the BPI for the Qs is turning back up and not giving us an extreme reading. For this to go back up, that means there's broader participation in the NASDAQ 100. Where the NASDAQ 100 did close above the 61.8% retracement level. A lot of folks that I listened to, they were really watching this level and thinking we were going to hit that and come back down. That still could happen. But the fact that we closed above that on a daily and weekly basis is showing a lot of improvement. Then here's the weekly chart showing that we're well above the anchored moving average going back to the all-time high. The small caps really improved, got above the 50 period and right up to their 200 period moving average. The RSI climbed back above 50 and is looking stronger, and the MACD is trying to roll back over positive. And the ratio between small caps and the S&P did show some improvement, but overall they continue to underperform. The small caps for the Elder Impulse system has changed to positive. And small cap growth did take a back seat on Friday when you compare it to small cap value, but still we're seeing this longer term strength in the background. The mid caps were able to get above both the 250 period moving average and close above this R1 resistance level. And the Elder Impulse system for the mid caps has switched to positive. And we're also seeing a little bit of a decline in Friday's session, but overall growth has really been outperforming value. The micro caps also were up over 3% and are well above 100. The dollar was up. That's kind of strange to have the dollar up and stocks up on the same day, but the fact that it's still trying to rebound is interesting. And looking at the home builders study where we were up with the S&P, we were up with the home builders, but not as much. The ratio still did quite well, but the relationship is falling off, but it still tends to be really strong overall. We're not seeing any real divergences right now on this chart. Keeping an eye on the financial sector, up over 2%, but still in a decline. The financials are still underperforming the S&P, but they did tick up. And the regional banking ETF was back up, but still in an overall downtrend. Looking at bonds, yields were up and bond prices were down. And then looking at our S&P to long-term bond study, we're still seeing this longer-term relationship show weakness. Shorter term, it's still looking okay, and the spread is getting really wide between the two. Our interest rate analysis, this is the basis of the supplemental video. When we look at the SPY, which is the ETF for the S&P 500, and then compare it to the 3 to 7 year Treasury bond, where we're really breaking out with this ratio, suggesting that we may enter into a soft landing. And with the employment report that came out, that suggests that maybe this soft landing thing is going to happen. Maybe we're seeing economic weakness in other areas, but employment is still strong. Maybe we can work through and get the economy back on track without going into a recession. At least that's the thought right now. That could change at any moment. Then the next chart is just an inverse of what we just looked at, where bonds are really underperforming, meaning that the S&P is outperforming. And then looking at the broad market, the S&P 1500, it is really outperforming the short-term Treasury bond ETFs. And another broad market measure, looking at longer-term bonds, also they are performing quite well. And then the tech sector is really outperforming the 3 to 7 year Treasury bond. Looking at the 1 to 3 month T-bill, which is cash, and comparing it to longer term bonds, this is still going up overall, and that's a little bit of a concern. When this is going up, that means there's uncertainty about interest rates. We had been seeing this ratio really dropping off, but now it's going back up, so we'll want to keep an eye on that. Growth continues to really outperform value on this chart, and value is underperforming growth. And then this is another area of concern where we're seeing the 3-month yield really break out above where we were at right before the great financial crisis. Is this some kind of a warning sign that we're being given? Our long-term chart, we're still below the red line on the special K. And then we're still looking pretty good with our MACD going up above 0 and above its moving average, suggesting that this breakout above the trend line is legitimate. An update of our possible positive scenarios, we're looking a lot better with the 19-day exponential moving average of the advanced decline ratio. We're above 0 based on price as well as volume. The Qs to the S&P continue to be strong. Discretionary showing a little bit of improvement, and large cap growth is still outperforming large cap value. Then our growth to value ratios, large cap doing good, turning down a little bit with the mid caps, but still looking strong. Still kind of lagging behind with the small cap ratio. And the S&P continues to outperform utilities, which could give a lot of support to the S&P 500. We're still below 0, though, when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. We are showing some improvement here, but we want to see this go above 0. And we're still seeing a little bit of weakness in our 50-period exponential moving average of the new highs minus the new lows. This red line is continuing to come down, even though our indicator did go back above 0. And growth against value with the S&P starting to trail off a little bit, but ever since February, it's been strong overall. 2-year Treasury yield continuing to go back up, so we don't know if this is going to be a valid spike or not. And then this is also more positive with the staples really underperforming the S&P. This ratio is going down. This could give some really good support to the S&P, but I try to point out here that when we spiked and started to go down, a lot of the upward movement had been done. Now it looks like we're continuing to follow through based on price. So what's our outlook for Monday? We still have earnings season to deal with. The technicals, they're pretty much positive now. A lot of the negatives that we've been looking at and negative divergences, they are showing some improvement. They're still there to a large degree. We have the IHS Market Services PMI, the final reading coming out, as well as factory orders. And then the big one will be the ISM Non-Manufacturing Index. And then the whole list of geopolitical events, as I said, we're shifting back more to focus on inflation and interest rates, wondering what in the world is the Fed going to do at their next meeting. Then here's the economic report coming up for the week. Notice that on Tuesday, we don't have any economic reports, and not a lot of big reports are coming out after Monday's release of the ISM Non-Manufacturing Index. And then here's the Stock Traders Almanac showing for June 5th. We tend to be more negative for the Dow, and we're neutral to negative with the S&P, where we're more neutral to positive with the NASDAQ. Then here's a new chart that was tweeted out by Jeffrey Hirsch, who runs Stock Traders Almanac. We're on the third trading day of the month, and we do see a little bit of strength in the early part of June, and it might be hard to read, but here's this tweet. It says, June's overall pattern in pre-election is similar to the last 21 years pattern with a brief, shallow pullback after a solid start. Okay, we've seen a pretty good start to June. In pre-election years, the mid-month rally has been much more robust, beginning around the 6th trading day and lasting until the 15th, followed by another modest retreat and rally into the end of the second quarter. So we start to come out pretty good in the early part of June. We pull back. Then we start to see some real strength in June, a little bit of a pullback, and then end the month in a stronger fashion based on historical patterns. This chart is put out by Don Bird, where it suggests that the best months actually go into July, where here we are in June, where we see overall strength, but then that often will continue to go into the early part of July. But when you look at what happened in 2011, we are going up with the S&P right now. We saw some weakness, a bounce back, and then the latter part of July into August, we saw some weakness. And then the Shivaco Capital chart showing pretty much the same overall thing. So what are our scenarios? Hard to go with the down one right now because the technicals are positive. The numerous negatives and divergences that we've been seeing are improving. You could possibly go with the up scenario now because our short-term ADX is now trending, but we are looking short-term overbought. So if you're longer term or if you're more conservative, you still are defaulting to that sideways pattern, even though the ADX is strengthening since it's above its moving average. It's still below 20 overall, but we are positive. The green line is advancing. But as I say here, the short-term ADX is trending positive. So our warning signs, the skew index that I showed you, it's a little extreme. We don't know really right now if that's a positive or a negative. The new highs, new lows for the S&P are not expanding when we saw kind of a breakout day. The BPIs continue to diverge even though they're showing a little bit of improvement. There are lots of negative divergences and there are still these negative signs that we're looking at in the background that are showing improvement, but they're still there. The VIX is still really showing a lot of complacency. The new highs, new lows for the NASDAQ are continuing to show weakness. The 3-month yield, it's above the great financial crisis levels. We just want to know, is that suggesting something? The small caps continue to underperform even though they had a really good day. And the mid caps also underperformed but also had a pretty good day. And then earnings season is here, but it should be ending at some point. Then looking at our positive signs, the longer term seasonality and setups, those are still there. The Copic curve and the Pring bottom fisher are both generating buy signals. The S&P closed above the downtrend channel and is still above that upper line. Posturing has switched back to risk on. Lower price levels may provide support if we see some weakness. The S&P continues to outperform utilities. That's very positive. The NASDAQ and NASDAQ 100 are just on a tear these days. The staples to S&P 500 ratio is declining, meaning that the S&P is outperforming staples. And small and mid-cap growth, it's still showing strength overall, even though we saw some weakness on Friday. And then will the resolution of the debt ceiling, it's kind of starting to be old news now. I think we may have been able to get some kind of short-term rally from the debt ceiling being solved, no matter what it was made up of. Will this produce some kind of sell the news reaction as we enter into the upcoming week? So what's our conclusion based on Friday's action? The S&P, it is positive, but we have a lot of negatives and negative divergences that are still there, but they are improving. On a short-term basis, we are positive, but we're looking pretty extended to the upside. We're still positive in the intermediate term, but we do have a few indications that we might have gone up too far too fast. Long term, though, we still remain positive. So thank you. I hope you have a very good weekend, and I will talk to you in the next video.